Good morning, friends. We welcome you to today's last session of the Ind AS series, and I welcome the speaker and the moderator, Jamna Madam. Jamna Madam, over to you. Kindly take over.
Thank you, Vijayji. Good morning, a very good morning to all of you, whoever is connected till now. I hope more are connected on our YouTube and gradually it will be on. So, friends, today we have last day of Ind AS education series, which was very well conveyed by Vijay Keval Ramaniji. It was visioned and pursued by him only, and really we are grateful to him that he is putting so much efforts to uh, make us learn so many things, not only as tax professionals but also as chartered accountant, audit as a auditor also. So, friends, today we have topic on Ind AS 111 joint agreements, Ind AS 27 separate financial statement, and 28 accounting for associates and joint venture. For this, we have a very pleasant personality and eminent speaker, CA Dipak Jaiswal ji. Before that, I would extend my greetings and warm welcome again to host associations. They are Tax Practitioners Association Thane, GST Bar Association Varanasi, Jose Professional Foundation, Association of Tax Professionals, Vellore, Tax Friends Association Mumbai, ITVA Prayagraj, Bhiwandi Tax Practitioners Association, Legal Relief Society, Kolkata. I welcome you all the participants and dignitaries of all these associations that and also extend thank that you all have combined to this noble cause. And now it's time to hear our eminent speaker. Before I hand him over the session, I would like to bring before you his very impressive and short introduction of him. Today we will have privilege to hear CA Dipak Jaiswal ji on all these standards. A very brief introduction about him is he is in audit and assurance practice and has experience of over 15 years in statutory audit, predominantly with Deloitte, EY, and KPMG. Financial statement audit and limited reviews of large companies listed and unlisted. Audit supports on right issues, quali- qualified institution placements of companies, gap conversion of various large companies, speaker in public forum on matters related to Ind AS Companies Act. He has dealt with he has key clients includes his key clients includes Ultratech, General Cement, Tata Motors Limited, Tata Chemicals Limited, Godrej, Consumer Products Limited, Everyday Industries India Limited, Pardeep Phosphates Limited, and others. His selected key projects are financial statement audit of large manufacturing companies with turnover ranging with US $1 billion to US $10 billion. IFC testing of large listed clients, right issue of large manufacturing companies, SOX audit of leading auto manufacturers, gap conversion of leading cement and fertilizer manufacturer company. So this is a very short introduction and his expertise what I have just presented before you, friends. With these words, it is really a privilege to have you, CA Deepak Jaiswal ji, with us today. I now request you to kindly take up the session. Over to CA Deepak Jaiswal ji.
Yeah, thank you, Jamuna ji. Thanks for introducing me. Good morning, friends. Thank Vijay Keval Ramani ji for giving me opportunity to present this
I
session.
think yeah, voice is little down. Please make it loud somehow. Who can make it? I
Hello.
don't know. Ah,
Yeah.
uh,
Yes. So I will try
yes,
to speak louder. So am I audible now?
yes, yes. Now it's okay.
Yeah. Yeah. So So I would like to thank you for giving me such a illustrious welcome, and even I would like to thank Vijay Kevalamani for giving me opportunity to present. I would like to apologize for not being able to present this session as per earlier schedule because of some health issues. So maybe the you'll see that the date mentioned in the presentation is 23rd, which was the original schedule of these presentations. So without taking much of time, I would like to straight away come into today's presentation. So friends, today we are going to discuss Ind AS 111, which deals with joint arrangement. Then we will discuss Ind AS 28, which deals with investment in associates and joint ventures. Then we will deal with Ind AS 27, which deals with the separate financial statement. So in between, we will have a break of around 5 to 10 minutes. After end of each presentation, I would welcome queries and questions from you all, and would be happy to take those questions after end of each presentation. So friend, now we will start with the presentation of Ind AS 111, which is joint, which deals with joint arrangements. So the
Deepak ji, again sorry to
yeah,
interrupt. The voice is very low. I think host there is problem from our side, or I because it's
okay.
No, no.
Let me change. Let me
Yeah,
change the mic. Just
now it is clear. Yeah, in fact, this is better.
it is clear.
Yeah,
yeah,
now
okay,
better.
little better.
So maybe because of internet issue, the voice is not clear
Maybe.
because I am not changing anything, and in between it is getting improved, and then
Okay, now it's a little better. Yeah.
now it's okay, right? Yeah. So friends, the key contents in IndAS 111, which is joint arrangements, are first we will discuss the key definition. Then we will discuss the core principle around those key definition, which actually drive the standard. Then we will discuss the types of joint arrangement. After that, we'll discuss the classification. What are the different types of arrangements and what are the classification of joint arrangement and the accounting treatments of joint arrangement as per classification in the financial statement of the investors. Then we will discuss the disclosure with respect to different type of arrangements. So friends, definition are are the foundation of this standard. So we will have to understand each and every definition very carefully because the definition actually determines the classification of the arrangement, which eventually determines the accounting treatment of arrangement in the books of investors. So friend, we will start with the definition of joint arrangement. So what is joint arrangement? So joint arrangement is an arrangement in which two or more parties have joint control. So arrangement or a investee where there are more than two parties can only be considered as a joint arrangement. So investment where there is a sole party or there is a single investor cannot be considered as a joint arrangement, and hence will be out of scope of the standard. So we will discuss the definition of joint control. So what is joint control? So joint control is the contractually agreed sharing of control of an arrangement which exists only when decision about the relevant activities require the unanimous consent of the parties sharing the control. So friends, here the critical point is that there should be contractual agreement between the participants of the arrangement. So there has to be two or more participants. All the participants should contractually agree to share the control and and agree to act unanimously in any decision making with respect to relevant activity of that arrangement, right? So friends, there can be arrangement wherein there are two or more parties, but if there are no contractual binding agreement between two or more parties wherein they are supposed to act unanimously, then that arrangement is not considered as a joint control arrangement, and then again it is scoped out of this standard. So friend, now we will discuss the definition of joint operation. So what is joint operation? So joint operation is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the asset and obligation to the liability relating to the arrangement. So friends, two basic classification of joint arrangement are joint operation and joint venture. So in joint operation, the key difference is that the participant or the investor has actually rights to the individual asset and obligation to the individual liabilities of the arrangement. So in case of joint operation, the parties to the joint arrangement are called joint operators, and they are considered to have rights to the asset and obligation to the liabilities of the arrangement. So now we will discuss joint venture, which is another type of joint arrangement. So joint venture is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the net asset of the arrangement. So friends, the basic difference between joint operation and joint venture is that in joint operation, the participants or the investor doesn't have right to the asset or doesn't have obligation to the liabilities of the arrangement. Rather, they have right to the net asset of that arrangement. So net asset means a single line of right on the net asset of that arrangement. So they don't have individual rights on the asset or individual obligation on the liabilities of the arrangement. So this is the basic difference between joint operation and joint venture. Yeah, so the parties who are part of joint ventures are called joint venturers, and like I discussed earlier, the parties who are part of joint operation arrangement are called joint operator. So now we'll understand parties to a joint arrangement. So friends, in an arrangement, there can be joint operator, there can be joint venturer. Along with them, there can be a party to joint arrangement who are not part of joint arrangement or who don't share joint control. So say suppose we take example of an entity wherein there are three parties, each parties have one third share of investment, and where say suppose there are three entities X, Y, and Z. X and Y have contractual binding between each of them to act unanimously. So X and Y can be said as a joint operator or a joint venturer, and and Z can be considered as a party to the arrangement, and it can be party to a joint operation arrangement or a joint venture arrangement. So friends, now we will discuss the principle in Ind AS 111. So the Ind AS 11 establishes a principle based approach. So the approach is not rule based, it's a principle based approach. So we are required to analyze a lot of facts and circumstances, and are required to make a lot of judgment while determining whether an arrangement qualifies for a joint operation or an arrangement qualifies for a joint venture. So parties to a joint arrangement recognizes their right and obligation arising from the arrangement. So whenever there are rights to the asset or obligation to the liabilities of an arrangement, then such arrangement, as we discussed, are known as joint operation, and in such cases the investors are required to consolidate the rights and obligation in their books of accounts. So friends, we'll discuss the core principles. So what are the core principles of Ind AS 111? So the core principle of Ind AS 111 is that a party to a joint arrangement determines that the type of joint arrangement in which it is involved by assessing its rights and obligation and accounts for those rights and obligation in accordance with that type of joint arrangement. So friends, like I discussed, the key difference between joint operation and joint venture is that in joint operation, the the participants or the investors has right on the asset. So the right, how we determine the rights, the rights can be in the form of a title on the individual asset, or in the form of legal form wherein the investor has rights on those assets. And obligations are like where the investors has obligation or responsibility of meeting those liability on a continuous basis, and in such circumstances it is said that the investor has right to asset and has obligation for meeting the liabilities, and those arrangements are considered as joint operation, and other arrangements which are not joint operation are considered as joint ventures. So now the critical aspect is the assessment of arrangement, right? So like we discuss, a joint control is an arrangement wherein all the parties or a group of parties have joint controls of the arrangement. In a joint control arrangement, there can be parties or a group of parties who have joint control over that arrangement. If there is no joint control, then the arrangement is outside the scope of IndAS 111. So what is joint control? So joint control is a contractually agreed upon sharing of control wherein parties whosoever are participant in an investment have agreed through a contractual agreement that they are going to act unanimously on any decision making activity relevant to operation of an entity. So in case there are no agreement between the participant of the investee, then that arrangement is outside the scope of Ind AS 111. So then those arrangement can either fall under either take the shape of a subsidiary or can take shape of a associate or an investment where parties has less than 20% of stake. And so first the assessment is to understand whether there is a joint control in any arrangement. Once it is concluded that there is a joint control, then we are required to make assessment whether the arrangement is a joint operation arrangement or a joint venture arrangement. So friends, the standard deals with two-step test for determining what is the actual arrangement, because based on the actual arrangement, the accounting treatment of the arrangement is determined. So like I said, that first step is to determine whether there is a joint control, and then once it is concluded that there is joint control, then the next step is what type of joint arrangement is there. So to decide whether the arrangement is a joint venture arrangement or a joint operation arrangement, we are required to analyze facts and circumstances. We are required to analyze whether there is a separate vehicle involved. Once we see that yes, if there is a separate vehicle involved, then we are required to do three more tests, which we will discuss in detail once the in this presentation later. So now we see that two different types of arrangements are joint operation and joint venture arrangement. So friends, we will discuss in detail what are joint operations and what are joint venture arrangements. So assessing the joint controls. So does the contractual arrangement give all the parties or a group of parties control to the arrangement collectively? So friends, the the important step to identify in any arrangement is whether there is an existence of collective control or not. So there could be cases wherein there can be two or more participants in an investee, but whether a collective controls is there or not is required to be assessed before assessing whether the arrangement is a joint venture arrangement or a joint operation arrangement. So if there is no collective control, then again the arrangement is outside the scope of Ind AS 111. So friend, what do you mean by collective control? So collective control means wherein two or more parties have control to take decision in any arrangement. So say suppose there are three parties in an arrangement, and each party has 33% stake in an arrangement. So all the three parties stake put together is 100% investment in an arrangement. So friends, if the arrangement talks about decision making qualification threshold of simple majority, then we can say that there is a collective control between all the three parties, right? So party, say suppose there are a party X, Y, and Z. So there can be collective control between party X and Y, and there can be collective control between Y and Z or X and Z, right? So the first step to move ahead in determining any arrangement is to see whether there is a joint collective control or not. So similarly, if we take example of another entity wherein there are, say suppose four investors, right? So each investor has 25% of stake. and say suppose the decision making threshold is 75%, then friend we can say that there cannot be collective control between two parties, right? So if we put together investment of two parties, then the threshold which comes is 50%, right, which does not qualify for any decision making activities. So in that case we can say that there is no existence of joint collective control, then such arrangement actually comes out of this out of scope of this standard. So once we have concluded that there is a collective control between the parties in an arrangement, then we are required to check whether the decision about relevant activities require unanimous consent of all parties or a group of parties that collectively control the arrangement. If there is no binding agreement between the parties who are enjoying collective control, wherein they have contractually agreed to have a unanimous consent on any decision making activity, then that arrangement is not considered as a joint arrangement and is an arrangement which is outside the scope of Ind AS 111. Wherever there is an agreement wherein the parties having collective control has agreed unanimously to act together, then such arrangement actually comes in the purview of Ind AS 111. Yeah, so friends, after meeting both the tests, first test which is collective control, and then second test which is uh, agreement or sharing of control to act unanimously, if both the tests are met, then we can say that an arrangement has joint control, and such arrangement actually gets covered under Ind AS 111. So friends, now we'll discuss what are different types of joint arrangement. So again, we are required to do analysis of parties' rights and obligation arising from the arrangement to determine whether the arrangement is a joint operation or a joint venture. So friends, we are discussing this concept again and again because these are very critical in understanding this standard. Once we discuss all this concept again and again, then this concept can get engraved in our mind, which can help us in understanding the standard in a better way. So again, we will discuss what is the definition of joint operation. So joint operation is a joint arrangement whereby the parties that have joint control of the arrangement have right to the asset and obligation for the liability relating to the arrangement. Those parties are called joint arrangement. So again, what are the critical aspect in joint operation? The critical aspects are that in an arrangement there has to be two or more parties. Those parties have actually uh, right on the asset of the arrangement and has obligation on the liabilities of the arrangement. Then such arrangement are considered as joint operation arrangement. Arrangement where there is right to the net asset of the arrangement are the arrangement which are considered as joint venture arrangement and are accordingly accounted as joint venture entities. And the parties who are participant in joint venture arrangement are called joint venturers. So friends, there are other factors also which are relevant in assessing whether there is existence of joint controls. So friends, there can be cases wherein we can see a situation wherein the rights or the holding in any arrangements are disproportionate. Say suppose there are two parties in an arrangement, say company X and company Y has a joint JV of company Z. So company X has investment of 75% and company Y has investment of 25% in JV chat. So friends, here we can say that there is a disproportionate uh, sharing of voting rights between X and Y. So in this case, if suppose the charter of the arrangement is to take decision based on simple majority, then in such case we can clearly say that there is no concept of collective control, and in such cases we can clearly say that X is actually controlling entity Z and is not sharing control with entity Y. So such arrangement or such facts also we are required to consider before deciding whether an arrangement is a joint venture arrangement or a joint operation arrangement. Similarly, there are other factors which also can be considered irrespective of having joint control or a legal form wherein the parties are sharing rights and obligation. We are also required to see some more factors or are required to consider some more facts of the arrangement. So such facts can be like we need to analyze the terms of shareholders agreement, friends. So there can be arrangements wherein, say suppose there is a joint venture arrangement between company X and company Y. Is having 50% investment in that arrangement, but the terms of shareholder agreement gives additional right to entity Y. Then in that case also we can say that the arrangement is not a joint arrangement, because in this case entity Y is getting uh, additional right over entity X. So such arrangement can also uh, come out of purview of Ind AS 111. So friends, we are also required to analyze the terminal provisions which can be there in the agreement of any arrangement, wherein, say suppose under termination provisions, either of the party of JV has additional advantage over other parties. So such cases also we can say that there's a disproportionate termination benefit which are assigned to the party, and if one party is having beneficial provisions over other party, then such arrangements are also taken out of purview of Ind AS 111. So friends, we are also required to analyze subsequent transactions. Say in joint arrangement, initially there are two parties. Maybe after 1 or 2 years, it is stated in the arrangement that either of the party will sell its stake to the another party. So in that case also, friends, we can say that the arrangement is too shorter to qualify as a joint operation or a joint venture arrangement. And in such circumstances also we'll have to see what is the longer form of arrangement. And if the longer form of arrangement says that there will be a single owner, and the other party or the other owner is going to sell its stake to the remaining party or to the remaining owner, then such arrangement also comes out of purview of Ind AS 111. Friends, we are also required to analyze the governance structure which are mentioned in the arrangement or in the charter of agreement of that arrangement, wherein if one party has exponential right of changing the governing body or appointing the governing body, then such party also has disproportionate rights over other parties, and such arrangement are also taken out of purview of Ind AS 111. Then the last point, which friends we are also required to analyze, is terms of any profit sharing arrangements. Friends, so maybe say suppose there is an arrangement of 50-50 JV between two parties, but the terms of profit sharing are again disproportionate. Maybe one party is has the right to take 75% of the profit of that arrangement, and the other party has right to take only 25% of the profit of that arrangement. So in such circumstances also we are we are required to conclude that such arrangement does not fall under the purview of Ind AS 111, as the controls are not sharing controls, and one party is having disproportionate right over other parties. So friends, we are also required to analyze certain intermediate step and business combinations. So friends, there can be cases wherein during the initial stages of step acquisition in business combination, wherein we can see that both the seller and the buyer uh, uh, may have coincidentally 50-50% stake, and which can be part of step acquisition in business combination. And later on, if we know that the buyer is keen in buying more stake, and then such arrangement also are not required to be considered under purview of Ind AS 111, because we knew that this arrangement is a temporary arrangement, and in the longer version of arrangement, the the acquirer is going to have stake of more than 50% and will have controlling stake in that arrangement, and then that arrangement will not be considered as a joint arrangement. So friend, like we have discussed theoretically the concept of collective control. Now through this presentation, we will understand conceptually what does collective controls means. So friends, we can see there is an arrangement wherein there are three companies: company X, company Y, and company Z, which has made investment in the arrangement. Company X has a 50% stake, company Y has 30% stake, and company Z has 20% stake. So friends, we can clearly see, if suppose the charter of this arrangement says that for any decision making, uh, that any decision making activity, the minimum threshold which is required is 75% of voting rights, then we can clearly say that company X and company Y has collective control between them. And company, if we take combination of company X and company Z, then we can clearly say that, see that the investment put together for company X and company Z is below the threshold of 75%. And we can say that company X and company Z does not have collective control. Then any arrangement between company X and company Z will be outside the scope of this arrangement, since they don't enjoy any collective control, which is the starting point of assessment of joint arrangement. So friends, here we can see that since company X and company Y has collective control, which actually met meets the first step to determine collective control. And once it established that there are collective control between two parties, then the next step is required to assess whether there is a contractual agreement between both the parties to act unanimously. So now friends, we will discuss another scenario wherein there is a party, say suppose we take example of setting up of manufacturing activity and the marketing of any newly launched product, right? So there are two parties who have entered into a joint arrangement, company X and company Y. So since company X has a local presence, company Y has delegated all its rights of decision making to company X, knowing that company X is a local party and will be better equipped with decision making policy. So in such circumstances, we can say that, friends, company X is actually acting on behalf of company Y in terms of making decisions. So here we can say that though the profit sharing arrangement is of 50-50%, but the decision making power actually rests with company X. And in that case, we can say that company X is actually controlling the arrangement, because technically company X has 100% control on the arrangement. So if such is the arrangement, then such this type of arrangement also comes out of purview of Ind AS 111. And in that case, company X will become parent of arrangement and will have to consolidate the arrangement. So friend, in if we take example of this situation, and in this example, if suppose there is a separate agreement wherein, in spite of delegating some of the right to company X with respect to doing day-to-day activity, if suppose company Y retains some power which are very critical, say suppose there are some veto powers which are left with company Y, then in such scenario we'll have to analyze the arrangement further, just to conclude whether Y also has a sharing of control with company X, and then eventually we can decide whether the arrangement is a joint arrangement or not. So friend, now we will understand the concept of implicit control. So friends, say suppose there is a separate vehicle wherein there are two investors, company X and company Y, and each and every entity is having 50% stake. So in this case, friends, we can clearly say that there is a implicit control implied here, because any decision can be made through a simple majority, and none of the party has majority, right? So just to render any activity or to make any decision, one party will have to take vote from other party, and in that case we can say that there is a implicit joint control between company X and company Y, in spite of the fact that they have not entered into any separate agreement wherein they have contractually bound each other to act unanimously, right? So in such circumstances, also we can say that since there is implicit control, such arrangement actually will fall under the purview of Ind AS 111. And these are typical arrangement of joint venture arrangement where both the parties have 50% investment. Collective control, not a joint control. So friends, like we discussed earlier in the presentation, so there can be collective control between more than two parties, and there can be more than two combination of collective control. But when there are such combination of collective control, then such arrangement could actually lead to not a joint arrangement and can be out of scope of Ind AS 111. So we will understand how such arrangement can be out of scope of Ind AS 111. So friend, if suppose there is an arrangement where there has been investment made by three companies: company X, company Y, and company Z. So company X has 50% stake, company Y has 25% stake, and company Z has 25% stake. So friend, say suppose in this arrangement the charter says that for decision making the minimum threshold required is 75%. So friend, we can say that there are more than one combination of 75%, right? So company X and company Y also can have collective control, and company X and company Z can also have collective controls, because both this combination ha- have actually 75% of stake, which is actually eligible for making decision in the arrangement. So if such is the arrangement, then such arrangement also comes out of purview of Ind AS 111, provided there is a binding agreement between any of the two parties in the arrangement. So we can clearly say that the collective control exists between company X and company Y, and company X and company Z. So there is no collective control between company Y and company Z. Say suppose if there is a uh, contractual agreement between Y and Z, then in that case also we will say that such arrangement is outside the scope of Ind AS 111, because the if we take together the investment of Y and Z, then the total threshold comes out to 50%, which is below the threshold of 75% for making any decision. So friend, if there is no agreement between company X and company Y, or company X and company Z, then such arrangement also is not considered as joint arrangement, because there is no joint control between any of the party, and each and every party will have to account uh, for the arrangement separately as per applicable standard. So in this case, we can clearly say that the applicable standard would be of associate, because the investment is more than 20%, and none of the entity has controlling stake in the arrangement. So friend, now we will understand the concept of joint de facto control. So friends, so this is very rare situation which can happen in practical life, wherein we can see that uh, there could be two parties who are part of a joint arrangement, and there can be many shareholders which might have investment in that joint arrangement, and each and every shareholder might have very minuscule stake. Say suppose each and every shareholder is having stake of less than 1%. So there could be a situation of more than 1,000 shareholders. We and then there can be case of two companies having, wherein company X is having stake of 23% and company Y is having stake of 25%. So friend, in such arrangement, if company X and company Y has contractually agreed to act together unanimously, then such scenario can also be considered as joint arrangement scenario between company X and company Y. So here, friend, we can see that in spite of the fact that company X and company Y has less than 51% of stake, but here it will be considered that there is a collective control between X and Y, because for making any decision, 48% of voting will be sufficient, because we can say that the other shareholders, they 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 don't have any arrangement to act together, and since there are many shareholders, it is practically not possible also to bring all the shareholders together. So friends, we have already discussed the concept of joint operation and joint arrangement. So now we will understand the principle behind classification of joint arrangement. So the classification of a joint arrangement as a joint operation or joint venture depends upon the rights and obligation of the parties of the arrangement. An entity determines the types of joint arrangement in which it is involved by considering the structure and form of the arrangement, the terms agreed by the parties in the contractual arrangement, and other facts and circumstances. So, friends, there are many tests which are required to perform to classify any arrangement between joint operation arrangement or a joint venture arrangement. So the starting point is whether there is a SPV or not. So if there is an SPV, then that arrangement could lead to situation of joint operation as well as joint venture. And if there is no SPV, then the arrangement will be considered as joint operation. So friend, we will understand in detail how such arrangement will lead to an arrangement of joint operation and not an arrangement of joint venture. So once we see that there is a setup of SPV, then we are also required to perform three more tests, which are test of legal form, test of any contractual arrangement, and test of other facts and circumstances. So in case there is an SPV, then we are required to see whether the legal form also confirm that there is no separation of rights and obligation between the investor and the investee, in spite of having a separate entity in between. So once it is established through legal form that there is no separation of rights and obligation, then we are also required to further analyze whether there is a contractual arrangement between the investors in that investee or not. So if even through legal form it is not concluded whether the rights and obligations rest with the investors, then we are also required to analyze the contractual arrangement between the investors. Say suppose through contractual arrangement, if it is concluded that yes, the rights to the asset and the obligation to the liabilities belong to the investors, then we will have to further analyze the other facts and circumstances which can lead to analyze whether substantially all the benefit from that arrangement actually flows to the investors, and the investors are obliged to meet all the liabilities of that arrangement on continuous basis. So all this analysis are events required in case there are SPV. If there are no SPV, then straight away the arrangement falls in the category of joint operation and are accounted presented in the financial of investor accordingly. So now, friends, we will discuss this four test model through which the different arrangements are classified. So the first step is like determination of structure. Like we discussed, if there is a separate structure, is the arrangement structured through a vehicle that is separate from the parties? So friends, if we see that there is a separate structure wherein the rights and obligations are separated from the investors, then such arrangement can either be a joint operation arrangement or a joint venture arrangement. But if there is no legal structure, then such arrangement actually falls in the category of joint operation. So friends, what do you mean by a legal separate vehicle? So a separate vehicle is a separately identifiable financial structure including separate legal entity or an entity recognized by statute. So friends, in this case, there can be a separate incorporated entities, or there can be a separate unincorporated entities. Like we take example of partnership firm or AOP, which under some jurisdiction has got a separate legal structure recognition, and some jurisdiction doesn't have separate recognition of legal structure. So, and friends will have to be careful that in isolation, the following example would not be considered as a separate vehicle. Say, suppose there are a separate set of accounting records, or there are separate bank accounts, or there is a separate operating segment. So, such arrangement or such structure will not take the shape of a separate vehicle or a separate entity. So, a separate vehicle has a single right to the asset instead of collection of right of obligations of individual assets and liability. So in this case, we know that the assets and liabilities which are lying in the separate vehicles are actually vested with the entity and not with the investors. So in such case, we can say that the rights to the asset and right to and the obligation to the liabilities rest with the vehicle itself and does not pass on to the investors. And accordingly, such arrangements are considered as joint venture arrangement, provided the other three tests are met. So, friend, in case we identify that there is a separate SPV, then we are required to do some more analysis, which is to understand the legal form of the structure. So, does the legal form of the SPV give the parties right to the assets and obligations for the liabilities? So, friends, in the legal form, if the legal form of separate vehicle does not confirm separation between the parties and the investors, like if suppose we know that in spite of having a separate entity wherein the arrangement has been entered between the investors, the rights and obligations through legal form of that entity lies or rests with the investors. Then in such cases also we can confirm that there is no separation of rights and obligations between the investor and the investee, and hence such arrangement would actually qualify as a joint operation arrangement and will be accounted accordingly. And in case the legal form confirms separation between the investor and the investee, then friends, we are also required to do further analysis, which are in the form of analysis of contractual arrangement, or understanding of other factors and circumstances to determine whether the arrangement is a joint operation arrangement or a joint venture arrangement. So friends, what is the analysis of contractual arrangement? So we are required to analyze whether the contractual terms give the parties right to the asset and obligation for the liabilities. So friend, in spite of the structure and the legal form, the contractual terms specify that the parties have rights and obligations. So friend, the arrangement should give primary rights and not secondary rights. So and it should give primary obligation and not secondary obligation. So how we can conclude whether the investor has right to the asset? So right to the asset can be established through ownership or a title deed of assets in the arrangement. If those are in the name of investors, then it can be construed that the investor has the right on the asset of the arrangement. And say if suppose there is a contractual arrangement of meeting the liability which are primary liability and not secondary liability, then in such cases also it can be construed that those obligations rest actually with the investor and not with the investee. And under such situation, the arrangement actually takes steps of joint operation and not joint venture and are accounted accordingly. So friends, once we have tested the legal form, the contractual arrangement, and then we are also required to analyze other factors and circumstances to conclude whether the arrangement is a joint venture arrangement or a joint operation arrangement. So what are the other facts and circumstances? So through other facts and circumstances, we are required to analyze whether the parties have right to substantially all the economic benefit of the asset relating to the asset arrangement, and thus the arrangement depends on the parties on a continuous basis for settling its liability. If we get affirmative answer with respect to this, then again the arrangement qualifies as a joint operation arrangement, and if not, then the arrangement eventually is considered as joint venture arrangement and is accounted accordingly in the books of investors. So friends, we can clearly see that there are four tests which are typically involved to analyze whether an arrangement is a joint operation arrangement or a joint venture arrangement. So friends, now we will discuss in details what are the other facts and circumstances which can help us in analyzing or concluding whether an arrangement is a joint operation arrangement or a joint venture arrangement. So, friend, we will discuss in details the other facts and circumstances in the arrangement. So, in other facts and circumstances, the starting point is base test, right? So, what is base test? Base test is like this is the base of any analysis, wherein we are required to analyze whether through the arrangement, whatever, say suppose there is a manufacturing unit which has been set up between two parties, wherein two parties have contractually entered into an agreement to invest, say suppose 50% each in a manufacturing entity, wherein it has been agreed that substantially all produce of that entity will be purchased by both the investors. So friends, here we can say that, say suppose the 90% of the produce, it is not necessary that 100% of the produce is required to be purchased by the investors. So even if it is 90%, it can be construed as substantial sale of produce of that entity. If such is the arrangement, then we can say that yes, both the investors are actually getting substantial economic benefit from operation of that arrangement, and that such arrangement can actually construed as a joint operation arrangement and not a joint venture arrangement. So friends, whenever there is a obligation or there is an arrangement of purchasing substantially all of the produce, so it can be either uh, manufacturing entity, or it can be any entity which is in the business of rendering services. Say if suppose the investors are substantial beneficial of produce or services of that arrangement, then such arrangement can be construed as a joint operation arrangement. When the investors substantially take all the benefit, then indirectly they are actually also taking obligation of meeting the liability of running that arrangement, right? Say suppose through purchase of such services and produce, there is actually cash flow to the arrangement which is required to meet the liability on continuous basis. So friend, this is the base test for determining under the analysis of other facts and circumstances, which can actually help us in analyze or help us in deciding whether the arrangement is a joint operation arrangement or a joint venture arrangement. So friend, now we will move to asset test and the liability test. So after the base test, the next step is asset test and liability test. So friend, in under other fact analysis of other facts and circumstances, the investors are also required to analyze or do the asset test and the liability test. If both the tests are met, then such arrangement also actually qualifies for an arrangement as a joint operation rather than an arrangement as a joint venture. So if suppose both the tests are met, then it can be construed that the arrangement or the investor uh, has substantial right on the asset of the arrangement and has substantial obligation in meeting the liability of the arrangement on continuous basis. So friends, the liability has to be a continuous and present liability, and it cannot be a contingent liability or which could be based on some future event. And and the asset and there should be a substantial flow of economic benefit to the investors. So if both the tests are met, then it can be construed that the arrangement is a joint operation arrangement and should be accounted accordingly. So friend, now we will discuss some examples under asset test, wherein we can say that if suppose there is a joint arrangement wherein, say suppose substantially, like we discussed, substantially all of the produce are sold to the investors. Say suppose there is a manufacturing of automobiles arrangement wherein the investor has contractually agreed to take 90% of the produce of that automobile setup. Then in that case we can say that the asset test is met as the substantial produce of that arrangement is actually sold to the investors. And in that case, even if 10% is sold to third party or to other party of the arrangement, then such arrangement can be construed as joint operation arrangement. So friends, there could be cases of uh, a past trend wherein it has been demonstrated that the investor has actually taken substantial produce whatever is manufactured to the arrangement, but such instances or such past trend cannot be benchmark for concluding that arrangement as a joint operation arrangement or a joint venture arrangement, because that could lead to a situation of intention of a management and not to any binding or a contractual agreement between the investor and the investee, wherein both the parties are contractually bound to purchase or sell the produce to each other. In such circumstances, either the investor or the investee can deny and cannot agree to enter into that transaction and can end up entering into transaction with third party. So such arrangement are also actually arrangement which are not considered as a joint operation arrangement, and such arrangement actually takes shape of joint venture arrangement. So now, friends, we will discuss one more scenario where could be a situation say suppose we take example of rig companies wherein there are two parties, company A and company B, where both the parties are engaged in the business of exploration of oil and gas, and then enter into setup of a refinery through a JV. So the friends, there could be a situation wherein say suppose company A rigs are operational since the beginning, and companies B are actually in development phase and would be operational maybe say suppose after a year's time. But in the first year of operation of the arrangement, we can see that the oil from rig of company A are only sent to the arrangement for refining. So in this case, we can see that the benefit of that arrangement is actually being taken by only party A or the company A and not by the company B. But in spite of the fact, sorry, where we have seen that for the temporary phase of the arrangement, say first year, the benefit is actually taken by company A. But in the longer version of the arrangement, company B is also entitled to take benefit. So maybe after first year of operation from say suppose second year, both the party uh, will be eligible to take benefit of refining, and such arrangement also wherein we see that as for the temporary phase, wherein only one party is beneficial to the arrangement. But if we on the longer run, if we see that both the parties are going to be benefited, then such arrangement also takes shape of joint operation and will be accounted as joint operation arrangement. So friend, there can also be situation wherein the produce are not sold directly to the investor. Say suppose we take example of uh, power generation company. Say there is a joint venture entered between two parties wherein the joint venture is in the business of generating power. And friends, we know that power cannot be stored, right? So those powers are actually first sold in the grid, and then the sale proceeds from the grid are actually flown to the investor. So such arrangement also, even if we see that the produce are actually not sold to the investor, but we see that the ultimate beneficial of the produce are actually the investors, then such arrangement will also take shape of joint operation and will be accounted as a joint operation arrangement. So friends, these were the cases of asset test. Now we will move on to discuss scenario of liability test, wherein we will discuss few examples. So in liability test, say suppose we take example of transfer pricing arrangement, right? Wherein there is a joint venture where the joint venturer or the investors has agreed to purchase the produce at cost plus margin. So friend, in such arrangement, we can see that because of cost plus feature, the arrangement is able to make some margin and is able to meet his obligation on day-to-day basis, right? So such arrangement also meet the test of liability test, and such arrangement will be considered as joint operation arrangement and not a joint venture arrangement. So in similar situation, if we take example of say if suppose the produce or the services are rented at market price. So friend, in that case there can be scenario of joint operation as well as joint ventures, because when the produce are sold at market price or at when those are sold at market price, then there is a risk of making profit as well as making losses, because again the market prices are determined based on demand and supply of product or services. So there could be cases wherein the market prices are less than the cost of produce or cost of rendering services. Then in such circumstances, the arrangement would end up making loss and would not be able to meet all its daily expenditure or its obligation. Then in such scenario, friend, it can take shape of joint venture. Say suppose in similar situation, if suppose there is a separate agreement that in spite of arrangement of purchasing material or services at market price, if there is a separate agreement between the investor and the investee, wherein if suppose the investee makes any losses, and then such losses if are made good by the investors, then friend again it will take shape of joint operation. So friend, in such situation we are required to carefully analyze the arrangement to determine whether the arrangement will be accounted as joint operation or joint venture. So, friend, similarly, there could be instances of temporary financing of any arrangement by a third party. Say, suppose at the initial stages of any setup, there has been financing by bank, and if suppose there is a binding agreement that the obligation with respect to repayment of those finances are actually resting with investors, then in such scenario also the liability test is met, because in such scenario also we can say that the primary obligation actually rests with the investor and not with the investee, and such arrangement will be accounted as joint operation arrangement and not a joint venture arrangement. So friends, in we have discussed that these are typically different scenarios of asset test and liability test, wherein both the tests are required to be met to qualify an arrangement to be a joint operation arrangement and not a joint venture arrangement. So if these tests are not met, then eventually the arrangement end up as joint venture arrangement and will be accounted as a joint venture arrangement. Yeah. So friends, now we will discuss the accounting treatment of joint arrangement in the financial statement of the investors or the parties. Joint operator recognizes in relation to its interest in a joint operation its assets, including its share of any asset held jointly, its liability, including its share of any liability incurred jointly, its revenue from the sale of its share of output of the joint operation, its share of revenue from the sale of output by the joint operation, and its expenses, including its share of any expenses incurred jointly. So, friend, in case of joint operation, we can clearly see that the party to the when joint arrangement is required to consolidate its share of asset and liability and share of revenue and expenses in its books. Sorry. A joint operator's accounts for the asset, liabilities, revenue, and expenses relating to its involvement in a joint operation in accordance with the relevant Ind AS. So before recognizing the assets, liability, revenue, and expenses, the joint uh, operator will have to analyze each and every accounting standard and is required to see whether the asset qualifies as asset as per the relevant standard and the liability qualifies for liability as per the relevant obligation, relevant standard. So financial statement of parties to a joint arrangement or joint venture. So friends, there's a a huge difference between accounting in a joint operation entity and accounting for a joint venture entity in the investor's books. So a joint venture recognizes its interest in a joint venture as an investment. It shall account for that investment using the equity method in accordance with Ind AS 28, investment in associate and joint venture, unless the entity is exempted from applying the equity method as specified in that standard. So friend, we are not going to discuss what are the scenario of exemption from doing equity accounting. I think which this we will discuss later on when we will cover Ind AS 28. So we can clearly see that in case the arrangement is identified or concluded at joint venture, then that investment is actually accounted for equity on equity basis, wherein a right to net asset is of that entity is only accounted in the financial statement of the investor. So it is a single line consolidation rather than consolidation of each and every individual assets and liability and revenue and expenses. Yeah, so disclosure requirement. So friends, I think disclosure requirement, there's a separate standard which covers disclosure requirement for joint arrangement, which is dealt in Ind AS 112, which has been covered in earlier presentations. So we are not going to separately discuss the disclosure of interest in other in joint arrangement, which actually is covered under Ind AS 112, which is disclosure of interest in other entities, outlines the disclosures required. So friends, now we are open for taking questions.
Let me check questions, please. Am I audible?
Yeah, yeah, you're audible.
There is one question. When it's outside the scope of Ind AS 111, which standard would be applicable?
So friends,
Suppose,
it
yeah,
will depend if it is if the investment is outside the scope of Ind AS 111, then we will have to see whether that investment qualifies as subsidiary or that investment qualifies as associate, or if that investment is outside scope of subsidiary and associate, then it can be accounted based on Ind AS 109, which is financial instrument accounting for financial asset.
okay, thank you. Another question is, in case of allotment of rights by government or any authority and allotted, making SPV for using the rights allotted, in the eyes of person allotting right only, original allottee is party. What is the stand in SPV? It is joint arrangement, or please, no, joint arrangement question is there. Again, further clarification for question is, please note SPV is basically made to raise fund.
So, like we discussed in the presentation that first we will have to analyze whether it's a joint arrangement or not. For concluding or for considering it to be a joint arrangement, there has to be a collective control, and then there has to be a binding agreement between both the parties to act unanimously. If these two features are not there in any SPV, then those SPV are actually out of purview of Ind AS 111.
Okay, I think there are relevant only two questions are there. You can take up the next tender, sir. Or
Okay,
you
then.
want pause, some 5 minutes
So
pause.
I think we will take a break of 5 minutes,
Uh,
and then we will
yeah,
resume
yeah,
after five
yeah,
minutes.
yeah. Okay, sir. Deepak ji, also please check if you can take another microphone or something,
Okay,
so that
okay.
it may be little loud also.
Now,
Thank you so much.
okay, okay. Thank you.
Yeah, thank you. Is the screen visible?
A screen, yeah, your folder is visible, not the presentation.
नहीं ओपन करिए तो हो जाएगा.
हाँ,
Yes,
अभी है,
it is.
अभी है. Yes, it is visible. Yes. जी सर, all yours, दीपक भाई.
Yeah. So I'm starting.
हाँ देखिए दीपक जी अभी
Welcome
आवाज
back.
क्लियर है. Now it's clear, better voice.
Yeah.
Yeah.
Okay. I have changed the microphone. Yeah.
Yeah. It was problem with that.
Okay, so friends, welcome back. So now we will discuss IndAS 28, which deals with investment in associate and joint ventures. So joint venture we have just discussed in earlier presentation. So I'll be discussing mostly around investment in associates. So friends, so what are in scope of IndAS 28? So IndAS 28 applies to.
Sorry, दीपक जी सॉरी अगेन. तो आपका आवाज फिर कम आ रहा है यानी आप ही धीरे धीरे बोल रहे हो मुझे लग रहा है.
नहीं
प्लीज टेक केयर
Hello,
क्योंकि लोगों
hello.
का जी जी हाँ जी जी.
Maybe the mic position is changing. Hello.
हाँ बिकॉज ना वो फिर बहुत स्ट्रेस हो जाता है सुनने में सबको.
Yeah, now it is okay.
I think it is okay. Yeah.
Yeah. So this IndAS 28 applies to investment in associates and joint venture. All other investments are out of scope of IndAS 28. So wherever there is an investment in associates and joint ventures, those investments are considered under this scope and are actually accounted accordingly. So what are the investment which are excluded from scope of IndAS 28? We will discuss. So investment in venture capital organization. So what are venture capital organization? Typically, these are the investment companies like mutual fund companies or any VC company which are actively engaged in investment activities. They are not engaged in any other business activity, but rather they are formed to make investment in entities either with the motto of current income or capital appreciation. So like investment linked funds, unit trust, mutual fund, etc. take shapes of venture capital organization, and these such type of entities are excluded from the scope of IndAS 28, and they are excluded from the scope of equity accounting. So rather, such entities actually follow fair valuation accounting under IndAS 109. Again, valuations or investment which are valued under IndAS 109 are also excluded from the standard. So the associate which are measured at, or subsidiaries which are measured at 109 are excluded from. So any which way subsidiaries are not covered under this standard. So associate which are measured at fair value through P&L are excluded from this standard. So such associate can be actually part of venture capital organization and are typically then excluded from the standard, because in such entities, the investment are actually done on fair value basis and not on equity accounting basis. And in such entities, any change in fair values are actually recognized in profit and loss account. So friends, we will discuss the definition of associate. So what are associate? So any investor having significant investment or significant influence in any entity are called associate of that investor. So typically it is presumed that whenever an investor has 20% or more investment in any entity, then that investment takes the shape of an associate. So the investment can be incorporated investment, or it can be an unincorporated entity. Like we discussed in earlier presentation, companies are incorporated entities, and partnership firms or AOPs are basically unincorporated entities. So what kind of investment can fall under the scope of this standard when there's an investment of 20% or more? And obviously there are other aspects also which are required to be considered before concluding whether there is any significant influence by any investor in an entity or not. So yeah, so associate investor has significant influence, like we discussed. Typically 20% or more investment is considered to have significant influence. What do you mean by significant influence? So significant influence means the power to participate in decision making activity of an entity, and these powers are not control or joint control. So there is a significant influence wherein the investor has power to participate in operation and decision making activity of an investee, and such power cannot be construed as a control or a joint control. So it cannot be a subsidiary or a joint operation arrangement. Again, consolidated financial statement. There is a linkage of this standard with CFS, because in CFS the investment wherein the investor has significant influence, or the investment which fall under the category of associate, those investments are consolidated in the CFS of investor on equity accounting basis, which is a single line consolidation. And entity where the investor has control, those entities or those investments are outside the purview of Ind AS 28. So we will also understand the concept of control. So what is control? So all this concept we must have discussed in our earlier presentation, but just for the sake of discussion and reiteration, I'm again discussing. So control is what? Control is the power to govern financial and operating policy and to obtain benefit from the activity of the investee. So by control, it means that the investor has exposure, or rather has right to variable return through involvement with the investee, and has power to affect those rights through its involvement in activity of the investee. So now we will discuss the definition of equity accounting. So what is equity method? So in equity method, initially the investments are recognized as at cost, and then the investments are adjusted for post-acquisition change in investors' shares of net asset, and those are adjusted for post-acquisition change in payouts. Like if there are payouts of dividend, then those are also adjusted from the carrying value of investment in the investors. Investors are required to disclose the share of investee profit and loss. So it can be share of profit and loss, or it can be a share of equity, depending on the nature of share. So, and accordingly, those are presented in the books of investors. So joint control, we have discussed in detail in the earlier presentation, so I'm not going to discuss it again. Why we are discussing joint control here? Because joint venture scenario can only arise where there is a joint control arrangement between parties, and joint venture accounting is also covered under this standard. Again, separate financial statement. So there is no linkage between Ind AS 28 and Ind AS 27, which is Ind AS on separate financial statement, because separate financial statement doesn't deal with accounting on equity basis. So equity accounting is excluded from separate financial statements. Hence, there is no linkage between separate FS and Ind AS 28. So separate FS are actually basically presented by parent, investors, or associate, or venturer in jointly controlled entities. And under separate financial statement, accounting for direct equity is done rather than interest in net result or net asset of that entity. So accounting of direct equity is like accounting of uh, either the investments are carried at cost or the investments are valued on fair value basis as per Ind AS 109. So, friend, we'll discuss the concept of significant influence. So, what is significant influence? So, significant influence is the power to participate in financial and operating policy decision, and it does not constitute to control or a joint control. So, a significant influence is said to be exercised by an investor when that investor is said to have investment of 20% or more investment in an investee, and the investor has power to participate in the financial and operating policy decision. So this power need not be controlling power or a joint control power. So while assessing significant influence, we are also required to assess the ability of exercising this influence, right? So friends, there can be scenario wherein because of lack of exercise of these abilities, the presumption of significant influence wherever the investment is more than 20% can be overcome. Say there can be situation where an investor has more than 20% of investment in an investee, but because of lack of ability of exercising their power, this presumption is overcome, and the investment is not considered as an associate in the books of investor. So, friends, while determining significant influence, we are required to identify direct investment as well as indirect investment. So, wherever there is an investment through subsidiaries, those investments are also considered while determining whether an investor has or a group has significant influence in any investee or not. So, friend, if we take example, suppose there is a parent company H and it has a 100% subsidiary company S, and that company S has 40% stake in associate A, and the parent company or the holding company also has say suppose 10% stake. So we know that if we put together investment of subsidiary and parent company, the total investment comes to 50%. So whenever an equity accounting will happen in the consolidated books of holding company, yes, the equity accounting for interest of 50% will be done, because there is a indirect holding of 40% through subsidiary. Yeah, so friends, while determining significant influence, we are also required to consider potential voting rights. So there can be situation wherein there are potential voting right which are currently exercisable by the investors. Say suppose without potential voting right, the investor has investment of 10% in an investee and has a financial instrument of say suppose a warrant or in the form of options which can give a potential equity share of 15% more in future. Then for the purpose of determining significant influence, the potential voting rights are also considered. So in such scenario, the investee will be considered as an associate for the investor, because the investor, in addition to 10% existing voting power, has 15% potential voting right, which can give the investor power of 15% more voting, that will ultimately lead to a voting right of more than 25%, which actually is the presumption threshold for determining significant influence in any investing. So again, friends, this potential voting power is not required to be substantive. Like there is a concept of substantiveness in business combination, which is not relevant in IndAS 28. So it is not necessary that those potential right needs to be substantive. So what does it mean? Substantive means even if these are not exercisable, or say suppose there is an option, there is a call option which is out of money at present, right? So once we see that uh, the option is out of money, it is considered to be non-substantive. But such cases are also considered as potential voting power while considering significant influence in any industry. Yeah, so friends, subsidy, we are already aware wherever there is a voting right of more than 50%, or power to govern a body is more than 50%, then such investees are considered as subsidy, and such investments are not such investment does not fall under the scope of Ind AS 28 and are not covered in the standard and not accounted on equity accounting basis. So friend, significant influence, like we discussed, whenever there is a voting power of more than 20%, it is presumed that the investor is having significant influence in the investee. But like we discussed in earlier scenario, we are also required to see other qualitative factors to see whether this presumption is overcome or not. So there can be cases wherein there is investment of less than 20%, but still the arrangement or the investee qualify as an associate because of other qualitative factors which we will discuss in detail. So what are the other qualitative factors? So friend, the other qualitative factors are like board representation. If we see that there is a substantial representation on board's combination of any entity, then say suppose more than 20% of the board members are represented by investors, then in such cases also the investments are actually accounted as an associate and are accounted on equity basis. Then there could be cases of investor having influence in decision about distribution of dividend, or they have rights in making decision dividend distribution policies. So in such scenarios also we can construe that the investor has significant influence on any investee, and the investee accordingly should be considered as an associate. So there could be also instances wherein the necessary technical information or the essential technical information are provided by the investors, and those technical information are very critical in operation of any investee, or in operation of day-to-day activity of an investee. So such arrangements are also, or such investments are also considered as an associate in the books of investors. So friends, evidences of change in management. So if we see that there is a substantial change in management of an investee, and those management actually represent the investors. So in such scenario also we can say that the investment takes the shape of an associate, and accordingly should be accounted on equity basis. So friends, there can be other scenarios also to analyze whether the arrangement or investment qualifies as a associate or not. So there could be instances where there are substantial transactions between investors and the investees. So in such cases also it can be concluded that the investors having significant influence in the investee, and such investee should be considered as an associate. Or friends, there could be instances of veto power, wherein any investors can have veto power through arrangement, through share purchase arrangement with other investors. So in such cases also it can be construed that the investors having veto power exercise significant influence on an investee, and should accordingly account for that investee as an associate. So friends, now we will discuss some of the scenarios which will give us idea of significant influence. So friends, so if there is a company named P which has subsidiary S and subsidiary V. Subsidiary V is a venture capital organization, and there is an associate which is company C. So friend, we can see that company P has 100% stake in both the subsidiary, uh, and there is a 10% investment through subsidiary S and 20% investment through subsidiary V, which is a VCO company. So for determining whether company P has significant influence on company C, we will have to consider indirect investment from both the subsidiaries, right? So friend, here we can see that if we consider the investment of subsidiary S and subsidiary V, the total investment comes to 30%, which is more than the presumption limit of 20%. So in this case, it can be construed that company C is an associate of company B and accordingly should be consolidated in the consolidation accounts of company B on equity accounting basis. But how the consolidation should be done? So friends, since we discussed earlier that wherever there's a investment company involved, then those investment company are actually taken out of scope of Ind AS 28 and are hence out of purview of equity accounting. So we can see that 20% investment is through subsidiary V, which is a VCO. So in case of company P, the equity accounting will be only done for the investment of 10% and will not include 20%. So this 20% accounting will be done based on fair value basis, which is covered under Ind AS 103. So this is the conceptual difference wherein for the purpose of the, identification of significant influence, indirect holding through subsidiaries are considered. But while doing equity accounting, the investment companies are actually excluded, or the investment through investment companies are excluded. So friend, now we'll come to a situation wherein through investment by subsidiary S and subsidiary B, company P actually enjoys control on company C. So friend, we can see that again through both 100% subsidiary, company P has indirect investment in company C through subsidiary S of 40% and through subsidiary V of 40%. So in this case, equity accounting will not be done in the books of company P for company C, because we can see that both the investment put together, there is a controlling stake in company C. So in the company C will be consolidated as a subsidiary in company P, indirect subsidiary in company P, and there will be accounting of 20% NCI in the books of consolidated books of company P. So in this case, there is an exception to the rule that we discussed earlier, that in spite of having indirect investment through subsidiary V, which is venture capital organization, but wherever there is a wherever there is a concept of controls, then in that case it is seen that whether investment through normal subsidiary and investment subsidiary, if both put together gives controlling power to a group, then that investee is accounted as a subsidiary in the books of holding company. So friends, now we will discuss the method of equity accounting. So how equity accounting is done in the books of investors. So so the starting point of equity accounting is the initial investment in investee are carried at cost. So what comprises cost? So we will discuss what are the components of cost for any investment. So any purchase cost which are made to acquire any investment are considered for determination of cost price, and all direct costs which are attributable in acquisition of that investment. Say suppose we take example of legal fee or a professional fee or a transfer taxes, all these direct costs are included while determining the cost in investment under equity method. So all this together, and accordingly the investments are carried in the books of investors. Then the second step is calculation of investors' share of post-acquisition profit or loss. So once the investments are carried, then subsequently the share of investors' profit or loss are adjusted in the carrying value of the investment. So how this share of profit or loss are adjusted in the carrying value of investment. So if there is a profit, then the profit is taken in the profit of the investor, and the corresponding credit is given to the investment, which actually increases the value of investment. And if suppose there is a loss in the investee, then the loss is taken in the P&L of investor, and the carrying value to that extent is reduced to the extent of loss incurred in the investee. Sorry. So yeah, so recognize investors' share of profit or loss in investors' P&L account. Then if distribution by the investee to the investors. So since equity accounting is done, the distributions are not accounted in the P&L. Rather, the distributions are whenever the right to receive such distributions established, the distributions are reduced from the carrying value of the investment of the investment in the investor's book. Then share of net asset not adjusted through P&L. So friends, there can be cases of revaluation of PPE, or there can be cases of foreign currency FCTN reserves, which are actually accounted through equity. So in such cases, the share of those equity are taken through OCI and are adjusted with the carrying value of the investment. So this increase in equity or reduction in equity are directly recognized in the investment through equity of the investors. And the example of such change in equity can be like property revaluation or foreign exchange translation differences. Now, ownership interests exclude voting rights exercisable in future. So friends, whenever equity accounting is done, like we discussed the scenario of potential voting share, right? So in that scenario, in the example where we discussed that the existing investment was of 10%, but the potential investment or potential voting right was of 15%. Both put together was giving investment of more than 25%, which is the minimum threshold for considering an investment as an associate. So in that case, if such is the scenario, then the equity accounting will be done for 10% share and will not consider the potential 15% stake. Application of equity method, using the equity method except when investment is classified as held for sale. So friend, again, under scope exclusion, whenever an investment is classified as investment held for sale, then those investments are taken out of scope of the standard, and those are accounted under the standard of Ind AS 10, wherein those investments are carried at cost or fair value less cost to sell, whichever is less, and no equity accounting is done for those investments once the investments are considered or classified as investment held for sale. And again, there is a equity accounting exemption when there are exemptions from consolidation. So friends, I'm sure we must have discussed the conditions or the criteria when there can be exemption from preparing CFS. So in such a scenario also, equity accounting is not done. When a parent has elected voluntarily or through exemptions of not presenting CFS, then the investments are not accounted on equity accounting basis. So what are the conditions of exemption of CFS? We will discuss in detail. Parents can elect not to prepare consolidated account on the basis that the ultimate controlling entity produces consolidated accounts that are available to the public. So there can be scenario where the ultimate parent company or the immediate parent company has decided to present consolidated financial statement complying all the IndAS, and in such scenario the parent can be exempted from preparing CFS, and once the parent is exempted, then the parent is not required to account for its investment in associate on equity accounting basis. And then again, further dealing with the scenario of exempted CFS, there can be cases where there are subsidiaries, wholly owned subsidiaries or partially owned subsidiaries, wherein the other shareholders of the subsidiaries do not object for not presenting CFS and are well informed. Then in such cases also the company can elect not to prepare CFS and not to account for the investment on equity accounting. And when the entities which are not public PI entities, where the equities or debts are not listed, or the entities which are not going in public for sale of its equity or debts, then such entities are also exempted from preparing CFS and are hence then exempted from accounting their investment on equity accounting basis. So friends, so these are the conditions. In addition to this scenario, there could be scenario wherein an entity has elected to prepare a separate financial statement. So in separate financial statement also investments are not accounted on equity accounting basis, rather those are accounted either at cost or, so there is a policy choice in such cases where the investment can be accounted at cost or based on fair value through P&L under Ind AS 109. Sorry. And again, equity accounting is also not applicable for investment entities or venture capital organizations. So friends, we'll discuss the application of equity method. So when equity method ceases, so these are the scenarios when accounting of equity method ceases, when associate become a trade investment. So whenever an associates are classified as trade investment, or those are classified as investment held for sale, then equity accounting from the date of that of classification, the equity accounting ceases, and then the investments are accounted as per applicable standard. Equity accounting also ceases once the associate become a subsidiary or a joint operation. So friends, there can be scenario wherein an investment in 1 year.
Deepak ji, very sorry. Again, the voice is very, very low. It is very, very low. I don't know
Hello.
what's the problem. Yeah, I think headphone is little better. I don't understand where is the problem, from our end or at your end. We are unable to understand.
So now is it
Yeah, it's
audible?
when you ask for no, it is okay, but afterwards it is going to be very slow, very low. It is.
Okay. Okay. So maybe I will have to shout.
Maybe.
Yeah.
Sorry to
So
interrupt.
okay. So technology is not supporting, so it's bad luck for me. I will have to strain my throats. So we were discussing application of equity method. So when equity accounting ceases, so whenever associate becomes subsidiary or a joint operation, then in that case is also the equity accounting ceases. So there could be scenario wherein first year of acquisition, there's a significant investment is accounted based on equity accounting basis. Maybe after 2 years or 3 years down the line, when the investors obtain controlling stake in that entity, then from the date the controlling stake is taken, equity account is accounted for based on is accounted as subsidiary. Yeah, application of equity method. So how equity method are applied, we will discuss in detail. So like we discussed while doing equity accounting, group shares are considered in the investment in industry. What do you mean by group shares? Means the parent share as well as subsidiary shares. So whenever there is an investment either by the parent or through subsidiaries, then the investment put together through parent and and subsidiaries are considered for application of equity accounting. So investment through JVs or associate are excluded for application of equity method in any group. So yeah, so it is mentioned that ignore group associate and JVs. So the only investment through subsidiaries, be it investment of associate, JVs or subsidiaries, those are actually considered in consideration of CFS. Now, after both the direct and indirect investments are considered, then the next step is elimination of investors' share of upstream and downstream transactions, which are actually considered as intra-group transactions. So what do you mean by upstream transaction and downstream transaction? So downstream transactions are typically those transactions which flows from investors to investees. Say suppose there's sale of material from investors to investees, and in such sale transaction is considered to be a downstream transaction, and vice versa. If suppose there's a sale of product from investee to the investor, then such transactions are said to be upstream transactions. So the elimination process in both type of transactions are different. So that is why we are required to understand the concept of downstream transaction and upstream transaction. So in case of say suppose we take example of sale of material for 150 rupees, wherein the cost of material is 100. So there is a profit of 50 rupees by an investors, and these materials are actually unsold in the books of industry. So in this case, when the CFS is prepared, then the transactions are required to be eliminated between investor and investee. So how these are eliminated? If suppose the investor has a stake of 20% in investee, then 20% of sale, which is 20 into 150, which is 30 rupees, will be eliminated in the books of investor. And similarly, 20% of cost, which is 50 rupees. So 10 rupees of cost will also be eliminated in the books of investors. And similarly, then vice versa, if we take similar example in case of upstream transaction, in that case the elimination will be only to the extent of profit, which is 20% on 50, 20% on 100. Sorry, so because 100 is the profit. So in that case, the investment share in the investors' books will be reduced to the extent of 20%, and investors' share of profit and loss from investee will be reduced to the extent of 20%. So basically, these are the differences between upstream and downstream elimination of intra-group transactions. So once these are eliminated, then we are required to see whether there is a goodwill on acquisition or not. So there is no under Ind AS 28, there is no requirement of recognition of goodwill separately, like as is the case of business combination under Ind AS 103. So in this case, the goodwill are actually included in the carrying value of the investment, and they are not recognized separately, but those are identified separately. How goodwill are identified? So goodwill are identified by first determining the cost. What is the cost which is borne by the investors minus the percentage of net asset acquired on the date of acquisition. So the net asset acquired on the date of acquisitions are determined based on fair valuation. So whatever is the fair value of the net asset acquired minus the cost, if the cost is more than the percentage fair value of net asset acquired, then it gives rise to goodwill. But again, like I mentioned, goodwill is not recognized separately, but it is included in the carrying value of the investment. So why it is important to recognize goodwill? Because so this goodwill is not treated as a goodwill under Ind AS 103, where there is a mandatory requirement of impairment testing every year annually. In case of equity accounting under Ind AS 28, whenever there's goodwill, such goodwills are actually tested for impairment only when there is an indication of impairment of investment in the book in the investor's book, and the amortization of goodwill is not permitted. Yeah, so there, friends, there can be a scenario of bargain purchases wherein the percentage of fair value of net asset acquired is actually more than the cost. In such cases, there could be scenario of negative goodwill. So negative goodwill are actually recognized in the P&L of investors in the year when significant when the investments are acquired. So after the goodwill, positive or negative goodwills are identified, then post acquisition the goodwills are or the carrying value of the investments are adjusted for depreciation if any or for impairment of investment. And again, impairment of investment is covered under IndAS 36. So application of equity methods. So friend, we will understand more concept of application of equity method. So there is a requirement of adjustment of fair value post acquisition, which can be on account of impairment or depreciation of asset. For equity accounting, uh, the financials of the investees are also considered, and the reporting period of financial statement of investor and investee should be as on same date, and it cannot and the reporting period, there cannot be gap of more than 3 months between the reporting period of the investor and the investee. So this is the rule, we can say that rule which is applicable for equity accounting. So the accounting period and the gap should be consistent. So the period of 3 months, say suppose the gap period is April to June, then this same gap should maintains every year. It should not be that in next year it will be July, August, or September, and the gap cannot be more than 3 months. So, friends, whenever there is a gap between the reporting period of the investors and investee, before equity accounting, adjustment for significant transactions are made in the books of investors for doing equity accounting of the investee. So, any significant transactions are identified which might have occurred between the reporting period of investors and the investee, and those significant transactions are adjusted in the fair value of investment before equity accounting of that investment is done in the books of investors. Friends, further before accounting of equity, the investor is also required to ensure that there is uniform accounting policies followed by, with the investors. So if suppose there are accounting policies mismatch, then those mismatch are identified, and the accounting policy of investors are made in line with the accounting policy of investor before doing the consolidation on equity accounting basis. So friends, here while doing adjustment for uniform accounting policies, there are a few exception rules. Say suppose there is an subsidiary which is an investment entity. So and we know that in investment entity the investments are carried at fair value through P&L. So there can be a mismatch of valuation of investment between investment company and non-investment company. So in such cases, the policy alignment is not required to be done. So there is a policy exception for investment company. So investment company will continue with approach of valuing its investment on fair value basis. Then adjustment for dividends on cumulative preference shares due but not included. So doing accounting doing accounting for equity method, if suppose there are preference shares in investee, then and we know that preference shares take the color of borrowing. So if there are unpaid, there are dividends which are cumulative, then those dividends needs to be adjusted before the profits are allocated for doing equity accounting. And friends, if suppose because of impairment or because of impairment in investee or because of share of loss in investee the loss exceeds the carrying value of the investment in the books of investor, then the carrying value is not reduced to negative. Rather, so there are two approaches, and there are accounting policy choices based on which either the either the investors can restrict it to zero investment, or it can take the balance as a deferred income in its books, which can later on be adjusted with any future profit earned through that investment based on equity accounting basis. So whenever the percentage of net asset is equal to zero, then recognize liability for losses under the obligation of investors, and then allocate future profit against those losses which are not recognized. So friends, so now we will again reiterate this concept of indirect holding. So we can see that there is an investment in associate A through subsidiary, which is 70% subsidiary. So while consolidation of associate A in parent company P, if we presume that there is a profit of INR 100, then P will consolidate INR 40 in its CFS. 70% will go to equity shareholder, and 30% will go to NCI. So 70% of 100 will comes to around 28, which will be allocated to equity holders, and 30% of 100, which is 12, will go to NCI in the books of company P, while consolidation of associate A. Indirect holding and strategic investment. So friends, like in this example, we will see that there is a direct investment in associate A by company H by 30%, and there's an indirect investment of 3% through wholly owned subsidiary company S. So if suppose there's a consolidation in the books of company H, which is equity accounting of associate, and equity accounting will be done for 33% rather than for 30%, because 3% is through indirect holding of from 100% subsidiary. So indirect holding via equity accounting as investee. So friend, in this example, there is a parent company H which has joint venture J and an associate A. So in associate 8, the company H has a stake of 25%, and through joint venture J, there is an indirect investment of 10% in associate A. So how the losses or the dividends will be accounted in the books of A, we will discuss in the example. So suppose we presume example of loss of INR 40, and say suppose the associate A distributes dividend out of its earlier accumulated profit of 200, then how this will be accounted for in the books of company H based on equity accounting basis. So in the H consolidation, share of loss of A will be accounted at rupees 10, which will be 20%, 25% of INR 40, and the dividend which is distributed 25% of 200 will be reduced from the carrying value of investment in company H, which will come to 15. So there will be a decrease in carrying amount of investment of A in the books of company H by 60, which will be 50 plus 10. And again, company H will have to account for dividend received from joint venture J, which will be 50% into 10% of 200, which will comes to rupees 10. So the PNL will in PNL, the company H will account for dividend received from associate towards the share of joint venture investment, and will reduce its investment towards share of investment in associate A by 60 rupees. So impairment of losses, so friends, impairment of losses is covered under IndAS 36. So principle of IndAS 36 are applied for determining any impairment losses, and also apply IndAS 109 to determining any additional impairment loss. Goodwill not recognized separately from net investment, therefore tested as part of carrying value. So we have already discussed that since goodwills are not recognized separately, these are included in the carrying value of the investment. So goodwill are not separately tested for impairment every year or annually, and are tested only when there is an indication of impairment. So while determining impairment losses, consider the net present future net NPV value of future operating cash flows and ultimate disposal proceeds, or NPV of future cash flows from dividends and ultimate disposals. And after considering all this thing, the final impairment amount is determined and are accordingly adjusted in the books of investors. So now, friends, we'll discuss the disclosure part in the books of investors. So while disclosing in the books of investors the fair value of investment, if published price quotations are available, then those are presented. The aggregate value of the asset, liabilities, revenue, and profit and loss from the share of associates are presented. If the investment is more than 20%, and those are not considered as significant, then the reason for not considering those investment as an associate are also required to be disclosed in the financial statement of the investors. So no significant influence. If greater than 20% ownership is there, then the reason why a significant influence is not there is also required to be stated in the books of investors. And if suppose the reporting period of associate is different, which has been considered for consolidation in the books of investor, then that reason for a difference in reporting date is also required to be presented in the books of investors. And if there are any restrictions which are associated with respect to transfer of dividend or loan repayment from associate to investors, then such restrictions are also required to be presented in the books of investors. And if there are any unrecognized share of losses of an associate because of the reason of carrying value becoming zero, then such unrecognized share of losses of associate are also required to be disclosed in the books of investors. Associates not accounted for using the equity method. So if there are any associates which are not accounted using equity method, then the associate not accounted for using the equity method are required to be disclosed. The total asset, total liability, revenue, and profit and loss of those associates are also required to be disclosed in the financial statement of the investors. Associate accounted for using the equity method classify investment as non-current asset. Investors shares of profit and loss are required to be disclosed, and then carrying amount of the investments are required to be disclosed. Investor shares of, if there are any discontinued operation in investing, and the investor share of discontinued operations are also required to be disclosed in the financial statement of the investors. Ind AS 37 provisions contingent liability and contingent assets. So investors shares of contingent liabilities incurred jointly with other investors are also required to be disclosed in the financial statement of the investors. If there are any contingent liabilities, then investor shares of those contingent liabilities along with the contingent liability of the investors are required to be disclosed in the financial statement of investors. So friends, now we are through with this standard. So we'll summarize the key points of the standard. So accounting for investment in associate using equity method. So whenever there is a significant influence in any investment, and those investments are considered as associate, and those investments are accounted based on equity method in the consolidated books of account of investors. So any investment more than 20% are presumed to be investment in associate unless there are conditions or there are lack of ability to demonstrate that those investors actually qualifies for investors where investment where investors has significant influence on. To not treat an associate if significant restriction on significant influences on financial and operating policies. So we have discussed the other factors which can lead to a situation wherein, in spite of having investment of more than 20%, because of those qualitative factors, the investments are not considered as investment, wherein the investors are required to have significant influence on the investment. Account for investors' share of net asset, profit and loss, and goodwill in consolidated financial statement. So under equity accounting, as now we have understood that the accounting is done on one line consolidated based on net accounting, and the share of profit or loss from investees are considering the profit and loss account of investors. Suppose there are share of equity or OCI, then those shares are also included in the books of investors for equity accounting. And goodwill, as discussed, are not present separately and are carried along with the investment value in the books of investors. So disclose accounting treatment, financial information restriction of significant investment on which greater than 20% are owned. So we have already discussed the disclosure aspect wherein there is an investment in associates. Yeah, so friends, now we can open for discussion if there are any queries.
Yes, there are certain queries. Jamna madam, please. I will read the queries.
Yeah.
Jamna ji, you are there? In financial year 2021, in Q2, company had both subsidiary and associate. But at the end of Q2, हाँ,
ये
जमुना जी, हाँ
हाँ
आप पढ़िए.
मैं ले ही रही थी सर.
हाँ
ओके.
बोलिए बोलिए.
I was mute, that's why. Okay, sorry.
No, no.
The question is, in financial year 2021, in quarter two, company had both subsidiary and associate. But at the end of quarter two financial year 2021, subsidiary investment got sold wholly and only at quarter. It got sold, and at quarter end, associate investment remained in books. In previous year, financial year 1920, whole year consolidation included both associate and subsidiary. Now, while preparing quarter two of 2021 consolidated statement, what about previous year comparative quarter? Deepak ji, is the question clear?
Yeah. So in the current in the previous quarter, the consolidation will continue as it is. So in the current year, since the subsidiary is no longer there, so only the
Yes.
accounting for associate will take place, and in CFS there will be consolidation of associate from current year, from quarter three.
So previous year figure to be kept nil, or what? How it will be presented? Like, I think or it can be
No,
regrouped,
so
or
in previous year, so there's no cases of
comparative.
regrouping.
Yeah, there
So
is.
previous year CFS will remain as it is.
Yeah.
Yeah.
Uh,
Because in previous year those subsidiaries and associate were there.
then another question is whether adjustment for equity method is post tax or pre tax. That is profit, dividend, etc.
No, it is always post tax.
Okay. Please explain upstream and downstream again with example.
Yeah. So
Oh.
so the downstream transactions are actually transactions between investor and investee. Suppose there is a sale of material from investor to investee, then it is considered as a downstream transaction. And vice versa, if suppose there is sale of material or services from investee to the investor, then those transactions are considered as upstream transactions. So why this differentiation is required? Because the elimination process are different between upstream transaction and downstream transaction. So if we take
Okay, I think,
example
yeah.
of downstream, say there is a sale of material for 150 rupees, right? And the cost of that material is 100 rupees. So there is a profit of 50, and there is a investment of 20% in an associate. So 20% of sale will be eliminated in the books of investor, and 20% of cost also will be eliminated in the books of investors. Okay, so this will ultimately give impact of 10 rupees in the books of investors. So 10 rupees profit will get reduced in the PNL of investor, and 10 rupees and 10 rupees will be reduced from the carrying value of investment in the books of investor. In case of upstream transactions, if we take similar situation, the elimination will be only of profit, and there will be no elimination of sales and cost, right? So the elimination will be only to the extent of rupee 10, which is 20% of profit of 50 rupees.
Okay.
Hope I am clear. Yeah.
Yeah, yeah. Thank you. Now, next question is, does the investor need to prepare CFS when the investment in associate is completely impaired or value reduces to nil due to negative net worth of associate?
Yeah. So even if there is a nil net worth, the CFS will be required to be presented until unless there is a disposal of significant stake. If the investment comes down below 20%, then only CFS is not required.
Okay. One more question is there. But I think Sanjay Sharma ji has asked for in quarter 3 financial year 2021, if only associate is consolidated, and in quarter 3 of financial year 1920 includes both associate and subsidiary, how figures will be compared in quarter 3 of current year? So it needs to be restated by consolidated only associate to make figure comparable. So are is there any comment for this, Deepak ji? He has
No, no.
suggested. So this is okay.
No, yeah, this is okay. Yeah. So there is no need of restatement of previous
Okay,
financial statement.
okay. So I think questions are over now. Uh, uh, Next one is remaining, na? One more is remaining, or it is over?
Yeah. One more is remaining. So which is Ind AS 27, which
I
deals
think,
with
na, Deepak ji, when you are leaning little ahead, no,
yes.
Deepak ji, when you are leaning ahead, na, then your
Yeah.
voice is coming okay. Otherwise, it is becoming very low. So because we
Okay.
want to understand this topic well, so voice clarity is requested from our side, please. I think your
Okay.
this
Okay.
laptop is not placed properly. I think. Please
So
lean
no,
it
no.
towards
So
the, yeah, towards yourself. Yeah, I think so. What I
okay.
realized
So
by just observing. Okay, thank you.
now
Thank
it
you.
is
Please
it
try
is
to.
audible, right? Now
Yeah, me.
go
Yeah,
for
you make it. Yeah, make it near to you. Yeah, I think.
and yeah. So we can go for a break of around 5 minutes,
Yeah, if
and
you need them, because we are running
we
out
will.
of time.
Actually,
Because
we can
running, we are,
complete, I think, though we don't have much slides in that.
Yeah. So maybe give me some time. So I will
okay.
come back in
Sure.
1 minute. Yeah, I will come back in
Okay,
1 minute.
okay, sir.
Okay,
Okay,
okay, okay.
sure. Friends, kindly gear up for third topic.
Yeah. So am I audible now?
Yeah. It is better. Always starting is better.
No. So actually, this mic position, when it is going back, then maybe there is some
Yeah,
difficulty.
just yeah.
Yeah. So I will have to hold it like this. Yeah. Yeah. So friends, now we come to our today's last topic, which is Ind AS 27, which deals with separate financial statement. So so separate financial statement is prepared in addition to CFS whenever the entity opt for. So there is no mandatory requirement of preparation of separate financial statement in India. So there can be some jurisdiction wherein separate financial statement are also required to be mandatory prepared. In that case, the standard becomes applicable. So separate financial statement standard is applied in accounting for investment in subsidiaries, JVs, and associate when entity elects or is required by law to prepare the SFS. So SFS is prepared in addition to CFS, and SFS can only be prepared wherever there is an investment in subsidiaries or there is an investment in JVs and associate. So where the investments are not in subsidiary, JVs or associate, in those cases SFS are not applicable and cannot be prepared. So financial statement that does not have subsidiary, JV or associate is not an SFS, and so those financials are outside the scope of Ind AS 27. So entity that is exempted from preparing CFS and applying from equity method may prepare a CFS. So entities which have taken exemption from preparing CFS and applying equity accounting, those entity may elect to prepare their financial statement based on SFS for more fair presentation of investment in subsidiaries, associates, and JVs. Yeah, so definition of separate financial statement. So separate financial statement are presented by parent and investors wherever there is an investment in subsidiaries, JVs, and associate. Those parents can prepare, if they at all they prepare SFS, then they can prepare SFS under Ind AS 27 in addition to the preparation of CFS. So direct equity interest are reported rather than interest in results and net assets. So equity accounting is not done in case of preparation of SFS. So wherever there is investment in associate or JVs in SFS, equity accounting are prohibited. So such investments are either carried at cost or those are accounted at fair value through P&L. So there is an accounting policy choice, and this accounting policy choice again needs to be consistent with CFS. If at all the investor is preparing CFS, say suppose we take example of an investment entity wherein the investment are carried at fair value in CFS, then in such cases, if such entities prepare SFS, then such entities need to carry those investment in SFS also at fair value through P&L, and should not opt for carrying those investment at cost. So they need to be consistent with the accounting method followed for investment in CFS as well as SFS. So presentation of SFS. So friends, so we discussed like SFS can be prepared in addition of preparation of consolidated financial statement. SFS can be prepared unless SFS can be prepared in case CFS are not presented, and CFS are not presented when the entities are not listed. In such cases, SFS can be prepared for investment in wholly owned subsidiaries or partially owned subsidiaries, or investment in JVs, investment in associates. So accounting for investment in subsidiaries, jointly controlled entities, and associated in separate, how the investments are accounted in subsidiaries, we are going to discuss. So there is a policy choice. So this such investment can be either carried at cost, or this can be carried in accordance with Ind AS 109, which is fair value through P&L. And if these investments are held for sale, then such investment should be carried under Ind AS 109, where such investment should be carried at cost, or fair value minus cost to sell, whichever is low. So using same method like we discussed, if suppose the investor is preparing CFS as well as separate financial investment, then the investor will have to be consistent while applying method of valuation of investment. If the valuation of investments are carried at fair value through P&L and CFS, then same method should be followed for those investment in separate financial statement as well. So entity should recognize dividend from its investee in the PNL of its SFS when its rights to receive is established. Since equity accounting is not followed in case of valuation of investment in SFS, if at all there is a distribution of dividend by investee, then those dividends are actually accounted in the PNL as income in the PNL of investors, and those are accounted when the right to receive those dividend are established, which is post approval of shareholders. So disclosures. So we will discuss the disclosure part. So there are two scenarios wherein the investors voluntarily or elect not to prepare CFS, and there are investors who, in addition to preparing CFS, also prepare SFS. So there are two different disclosure requirement in both the cases, and the only difference is in case the investor has opted for exemption from preparing CFS, then that statement is required to be stated in the SFS that such investors are actually have taken this option of not presenting CFS. Otherwise, rest all disclosures are similar in case of SFS, wherein entity elect to prepare SFS in addition to CFS. So this disclosures mostly comprises that in separate FS for parent who elect not to prepare CFS statement that the FS are separate as a FS and not a consolidated FS, and the exemption has been availed is required to be disclosed. The name of the country of incorporation of ultimate parent who produces the consolidated FS is required to be disclosed. The residency of entity, if the residence is different from the parent company, and the addresses where publicly the FS can be available or can be obtained. A list of investments in subsidiary, jointly controlled entities and associate, the name of investment, the country of incorporation, the ownership interest, the voting power if it differs from the ownership interest, and description of method used in accounting of valuing those investments are required to be disclosed in SFS. So similar disclosures are required also in case of a separate FS where the parent prepare FS in addition to CFS. So the separate FS of parent venturer in jointly controlled entity or investor in associate state that the statement are separate FS. The reason why prepared separate FS if these are not mandatorily required by law. A list of significant investment in subsidiaries, jointly controlled entities, associate, name, country of incorporation or residence, proportion of ownership interest, voting power if different to ownership interest, and description of accounting method used in preparing SFS. So these are the basic disclosure which are required to be disclosed in SFS. Yeah, so we are done with SFS. Any question on SFS?
Let me check the questions if any.
No, there are no questions.
Okay, so it was really wonderful, Deepak ji.
Yeah,
And
thank
since
you.
there are no questions, still, if anybody wants to ask, he may raise hand by the time, because I thought it will take a little more time, but it ended up very fast. So it's nice. We will get little time. Wait. Uh, so Vijay ji, shall I offer the vote
Yeah,
of thanks
yeah,
or
yeah.
any announcement is there
And
before
आप
that?
दे दीजिए फिर मैं closing announcement देता हूँ.
So friends, I hope we all must have got really a very better and clear understanding about the standards discussed today by our learned speaker. Even though it may appear, apparently it may appear some arrangement, but and we may feel that these standards will apply to them, but it is not so that, because as it was very well explained by our speaker that we have to undergo many tests like controlling powers. So it was very interesting, really. It was very enlightening to us that we have to first check whether any arrangement is it comes under this compliance or not. So thank you, Deepak ji. You very well explained all these things and in detail with case studies. Although there was some problem with respect to uh, voice, it was not that loud, but we could understand it very well. And we hope we will be again in touch with such any further for further clarification if required. As
Sure.
already announced by Vijay ji that he is going to take some another program also. So he is always just now he say in morning he was saying कि हाँ अब तो मैं थक गया हूँ लेकिन again अभी 1 घंटे में आ गया कि there is some other another problem in another project in pipeline. तो दीपक विजय जी uh, 1 घंटा तो आप कांस्टेंट रहो मैं ये कह रही हूँ कितना भागोगे. Anyway, it was my heartfelt thank to our today's learned speaker CA Dipak Jaiswal ji and to all the organizers who has supported and organized this program, and at the most the participants, because without participation of you people it cannot become a program which we can say successful. And really your participation only makes us see your participation has only made Vijay ji again to take decision that he will take another program because you motivate us. And we request you to whenever you register for any such program, do participate it by there is a YouTube also or direct entry also, and you have done it. Really, it was very encouraging. Thank you from core of our heart. And of course, many thanks to Vijay ji again and again because this pain it is since 1st August, and before that he must have been involved before 1 month of that. So it's 3 months constantly for this program I can say at least. For he has taken many more other programs also, but for this series he must have put at least 3 months efforts and time and coordination and all, you all know. So how much tough it is behind the curtain, you must appreciate it. And we, Vijay ji, from on the behalf of all organizers, as a conveyor, we extend our heartfelt thanks to you. Thank you, everyone. And now over to Vijay ji, whatever he wants to announce.
Thank you, Jamna madam. Thank you very much. Thank you, Deepak ji, for the wonderful session, and thank you, Jamna ji, for
Thank
the
you.
beautiful moderation. If anybody wishes to say anything about the series or some suggestions, they are open. We'll have a 5 minute open session, and then I would give my final vote of thanks. Pankaj ji, you would like to say something?
Oh, it was a great experience, Vijayji. Since though I don't have much of work in India, but still it was a great learning. In this pandemic, I had to study India as I was to appear for some online examination, and that and thereafter when I attended this webinar, it gives a lot of experience and new things which came to our knowledge, which we were missing rather, and very nonsense and very small things we could capture in these discussions.
Thank you, friends, for the support. I would like to thank all the faculties first for having accepted our invitation, and it's difficult to understand that they had given time 2 months prior and they had booked their schedule because everybody had to plan in spite of some certain issues coming up. And yes, we did face certain difficulties, but we have to reschedule because when the course goes up to 2 months, it does happen. Uh, we had lot of courses on income tax and GST, so we said let us do something different which may help because the GST income tax everybody has been doing all across the country. It has been going on. So that's why we ended up on IndAS, and I would like to thank all the participants. We had a registration of 568 paid registrations. I would like to thank them, everybody, for the cooperation. And all throughout the series, everybody has cooperated well. There may have been certain mistakes on our side. So, on behalf of the core committee, we would like to apologize. We have certificate of participation that we had said we have uploaded it on the Google Drive. The links have been shared on the chat. The links have been shared on YouTube. The links have been shared on the WhatsApp group as well as the Telegram group. On the Google Drive, just go. You will find the Excel sheet. Check your name, check your serial number, and the certificate with the serial number is there. Please download. That is the certificate. We also have sent a feedback form. All are requested to kindly give us the feedback form so that we can do some improvements. Jamnaji, we had not planned anything and still we have not planned, but there was always a pressure on me to do at least two things. One is a basic course on TDS because TDS is one thing which is untouched, especially for the office staff like filing of returns and corrections and all. And one was a course on international tax. So we are still in talks. I am not saying that we will be starting, but we are still in talks. We will be working.
ऑडिट हो जाने दो सर.
Oui, Abhi, and then
हाँ.
lastly, I would like to thank all my core team and all the seven associations who supported us, and they have been with us since the beginning. Since our webinar days, we started the webinars. They came in. We had a 2-day national tax conference, which was made successful because of the association. And here also, everybody has put in the effort. All the association office bearers, all the moderators, they have taken out time to moderate individual sessions apart from the faculty. So I should be thankful to all the moderators also who have supported. And yes, last but not the least, all the participants. Till then, looking forward to meeting you all for the future. Yes, I would be failing if I would not recognize the blessings of our seniors like Jagdish Nankani ji, who has been a mentor and a guide, and other seniors. And definitely, I would like to also thank the presidents and office bearers for having reposing the faith in me for conducting all these programs. Whatever we have been deciding, nobody has uh, come out that array ye issues nahi hai. And the core committee, it has been a smooth running and we have had a good support. Thank you all. Looking forward to see